Ladies and gentlemen, today I want to begin with a simple but powerful idea. History does not whisper before it changes direction, it gives signals. Most people ignore them. Some people doubt them, but a few recognize them early and position themselves accordingly. Right now, one such signal is flashing in the financial system, and it carries a metal older than banks, older than currencies, older even than modern economics itself: silver. When one of the largest financial institutions in the world sends out what can only be described as a $309 silver alert, it is not noise. It is not coincidence. It is a message. And the question is not whether the system is shifting. The question is whether you are awake enough to see it. When Bank of America issues what is effectively a $309 silver alert, it should be interpreted as far more than a routine market adjustment. It represents a visible acknowledgement of mounting pressure within institutional silver positioning. Large financial institutions operate with access to superior data, liquidity channels, and risk models. So when one of them signals distress or recalibration in a specific asset, it reflects forces that have already been building beneath the surface for some time. This is not speculation driven by retail enthusiasm, but a response to tightening physical supply, rising delivery costs, and the growing difficulty of maintaining traditional exposure structures in the silver market. The hook lies in understanding that institutions do not move publicly unless the cost of staying silent has become higher than the cost of revealing stress. At the institutional level, silver exposure has long been managed through complex paper instruments designed to provide flexibility and leverage while minimizing the need for physical settlement. However, as physical availability tightens, these structures become increasingly fragile. A $309 alert implies that the economics of replacement, hedging, or delivery have shifted dramatically, forcing recalculations that cannot be ignored. This is where the signal becomes powerful. It suggests that price risk is no longer theoretical, but immediate. When replacement costs surge, balance sheets feel it, risk committees respond, and market narratives change rapidly. The real hook here is that institutions are reacting to constraints, not forecasts. And constraints are far more influential than opinions. This development also highlights a broader structural tension between paper pricing mechanisms and the realities of physical supply. Institutions rely on orderly markets, predictable liquidity, and the assumption that positions can be rolled or closed without disruption. Rising silver alerts undermine those assumptions by revealing stress points in inventory access and cost predictability. When a major bank signals such strain, it effectively validates what physical market participants have been experiencing quietly for months. The engaging reality is that the physical market is leading, while the paper market is being forced to catch up, often abruptly and at great expense. From an economic signaling perspective, this type of institutional alert acts as an early warning indicator rather than a lagging one. It suggests that risk is being repriced in real time, not in response to a crisis already visible to the public. The hook is subtle but powerful. By the time such signals become common knowledge, the underlying imbalance is usually well advanced. Bank of America's action therefore reflects not just internal risk management, but a recognition that the silver market is entering a phase where traditional pricing and hedging assumptions may no longer hold, forcing even the largest players to adapt under pressure rather than on their own terms. The pruriest, exploding physical silver premiums are one of the clearest market signals that a structural disconnect is forming between paper-based price discovery and real-world availability in efficient markets. The price quoted on screens should closely reflect the cost of acquiring the underlying asset. When premiums surge well beyond historical norms, it indicates that the quoted price is no longer sufficient to secure physical metal without delay, negotiation, or additional cost. This is not a temporary anomaly caused by retail excitement. It is a manifestation of stress within the supply chain where demand for immediate delivery is colliding with constrained inventories. The hook is simple but powerful. When the price you see cannot buy the asset you want, the market is already broken. Paper silver markets are built on the assumption that most participants will settle financially rather than demand delivery. Futures, options, and unallocated accounts function smoothly only as long as confidence in convertibility remains intact. Rising physical premiums challenge this foundation by revealing that actual metal is becoming scarce relative to the volume of paper claims. As premiums expand, they expose the leverage embedded in the system and raise uncomfortable questions about how many promises exist for each available ounce. The engaging reality is that trust, once questioned, does not fade gradually. It shifts abruptly, and markets reprice faster than narratives can keep up. This divergence also reflects a broader shift in investor psychology. Participants are increasingly distinguishing between owning exposure and owning the asset itself. Paper instruments offer convenience and liquidity, but physical ownership offers certainty. When economic uncertainty rises, certainty commands a premium, and markets begin to price that difference aggressively. The hook here lies in recognizing that premiums are not merely costs. They are votes of confidence for physical reality over financial abstraction. Every additional dollar paid above spot is a signal that reliability has become more valuable than efficiency. From an economic standpoint, expanding premiums undermine the credibility of traditional price benchmarks. If spot prices fail to reflect true replacement costs, they lose their effectiveness as indicators of supply and demand. This forces a recalibration across the market, as refiners, dealers, and institutions adjust pricing models to reflect actual conditions rather than theoretical equilibrium. The compelling insight is that physical markets often lead during periods of stress, while paper markets follow reluctantly, adjusting only after imbalances become impossible to ignore. Ultimately, exploding premiums signal a reordering of market priorities. Liquidity, leverage, and convenience are being repriced against availability, security, and immediacy. This shift rarely reverses quickly once it gains momentum. The hook for those paying attention is that premiums do not explode at the beginning of a story. They explode when a system has already been stretched to its limits, and the cost of certainty suddenly outweighs the comfort of assumption. The surge in demand for physical silver is being driven by a rare convergence of industrial necessity and monetary hedging, positioning silver at a critical intersection of economic growth, inflation dynamics, and systemic risk management. Unlike many commodities that serve a single dominant function, silver is embedded deeply within modern industry, while simultaneously carrying a long history as a store of value. This dual identity creates a unique demand profile that intensifies during periods of economic uncertainty. The hook lies in recognizing that silver is not benefiting from one narrative, but from multiple forces accelerating at the same time, each reinforcing the other. On the industrial side, silver is indispensable to sectors that are central to long-term economic policy objectives, including renewable energy, electronics, medical technologies, and advanced manufacturing. These industries are not discretionary. They are strategic. As governments and corporations push forward with electrification, digital infrastructure, and energy transition goals, silver consumption becomes less sensitive to price and more sensitive to availability. The engaging reality is that industrial buyers do not wait for market dips when production schedules are at stake. They secure supply even at higher costs, creating a persistent baseline of demand that does not retreat easily. At the same time, silver's monetary role is reasserting itself as confidence in fiat systems weakens under inflationary pressure and expanding debt burdens. Investors seeking protection are increasingly drawn to assets that exist outside the financial system and cannot be diluted by policy decisions. Silver's affordability relative to gold broadens its appeal, bringing in a wider range of participants who are motivated by preservation rather than speculation. The hook here is that this demand is defensive, not opportunistic. And defensive demand tends to be more durable during periods of instability. These two demand streams interact in a way that amplifies market tension. Industrial consumption steadily reduces available supply, while monetary demand absorbs remaining inventories, tightening the market from both ends. This creates a feedback loop where each additional ounce allocated to one use increases the value of the ounces remaining. The compelling insight is that silver is being pulled simultaneously by economic expansion and economic straw, a combination that is historically rare and structurally powerful. From an economic risk perspective, this dual demand transforms silver into a strategic asset rather than a cyclical trade. It becomes a hedge not only against inflation, but against supply disruption, policy uncertainty, and financial system stress. The hook for those paying attention is that markets struggle most when assets refuse to fit neatly into a single category, and silver's refusal to choose between industrial metal and monetary safeguard is precisely what is driving its growing relevance in the current economic environment. Institutional signaling in the silver market has historically functioned as a leading indicator rather than a reactionary one, often appearing before broader shifts in monetary confidence become visible to the general public. Large financial institutions do not adjust positions or issue alerts based on short-term price movements alone. They respond to changes in liquidity, counterparty risk, and the cost of maintaining exposure. When such institutions begin to signal stress or recalibration in silver, it suggests that underlying assumptions about stability and convertibility are being challenged. The hook is subtle but critical. Institutions move early because they must, not because they want to. Silver occupies a unique position within the financial system because it bridges commodities and monetary assets, making it especially sensitive to shifts in confidence. When institutions adjust silver exposure, they are often responding to pressures that extend beyond the metal itself, including currency debasement concerns, rising interest rate volatility, and diminishing trust in long-dated financial promises. These pressures tend to ripple outward, first affecting precious metals, then currencies, and eventually bond markets. The engaging insight is that silver often absorbs stress quietly at first, long before it erupts in more visible asset classes. From a monetary perspective, silver premiums increase when participants begin questioning the purchasing power of fiat currencies. Inflation, expanding debt levels, and aggressive monetary interventions erode confidence gradually. But behavior changes abruptly when holders of capital decide that preserving value is more important than chasing yield. Demand migrates toward assets that cannot be created at will. Silver, accessible yet tangible, becomes a natural outlet for this transition. The engaging reality is that premiums do not rise because people are optimistic. They rise because people are cautious, and caution spreads faster than confidence. Premium expansion also reflects stress in settlement and delivery mechanisms. Financial systems rely on smooth clearing, predictable timelines, and counterparties that can perform under pressure. When these assumptions weaken, market participants seek certainty even at a higher cost. Paying a premium for physical silver is, in effect, paying for assurance. The hook here is that assurance becomes expensive only when it is scarce, and scarcity of assurance signals deeper systemic unease rather than temporary market imbalance. As premiums rise, they challenge conventional portfolio strategies built around liquidity and paper diversification. Assets once considered safe because of their market depth or institutional backing may no longer provide the protection investors expect during periods of stress. In this context, real assets regain strategic importance, not as speculative trades, but as stabilizing anchors. The compelling insight is that diversification fails when everything depends on the same monetary foundation, and silver premiums expose cracks in that foundation. Economically, this makes silver premiums a diagnostic tool rather than a secondary metric. They translate abstract monetary concerns into measurable cost. The hook for those paying attention is that premiums move before policy responses, but supply constraints in the silver market are intensifying the sensitivity of prices and premiums, creating an environment where even relatively small shifts in demand can produce outsized market reactions. Unlike many commodities, silver supply cannot be expanded quickly in response to higher prices. Mine development requires long lead times, significant capital investment, regulatory approval, and geological certainty, all of which limit the market's ability to respond elastically. The hook lies in this structural rigidity. When supply cannot adjust, the burden of balance falls entirely on price, and price rarely moves gently under pressure. A significant portion of global silver production is a byproduct of mining for other metals such as copper, lead, and zinc. This means silver output is often determined by the economics of entirely different markets. Even if silver prices rise sharply, production does not necessarily follow because miners base decisions on their primary revenue streams. The engaging reality is that silver cannot simply be turned on when demand increases. This disconnect between price signals and production response introduces persistent fragility into the supply side of the market. Above-ground inventories further amplify this sensitivity. Years of steady consumption, combined with limited investment in new mining capacity, have reduced accessible stockpiles. Much of the remaining silver is held in forms that are not easily mobilized, such as long-term industrial use, private holdings, or strategic reserves. When demand accelerates, the pool of readily available metal shrinks rapidly. The hook here is that scarcity does not need to be absolute to be disruptive. It only needs to be sufficient to create uncertainty about availability. This constrained supply environment magnifies the impact of incremental demand from both industrial users and investors. A modest increase in solar manufacturing, electronics production, or physical investment demand constrain distribution. Networks and drive premiums higher even if headline spot prices lag initially. The compelling insight is that markets often underestimate the nonlinear effects of tight supply. What appears manageable under normal conditions can become destabilizing once buffers are exhausted. From an economic perspective, such conditions increase price elasticity asymmetry, prices rise faster than they fall, and volatility becomes skewed to the upside. Participants are forced to compete for immediate delivery rather than rely on future availability, accelerating price discovery. The hook for attentive observers is that when supply constraints dominate, markets stop behaving predictably. Small catalysts produce large consequences, and silver's price dynamics begin to reflect not just demand strength, but the fragility of the system attempting to accommodate it. Rising silver premiums function as a subtle but powerful early warning indicator of underlying monetary stress, often revealing fractures in the financial system before they surface in mainstream economic data. Premiums rise when the cost of acquiring physical metal diverges from its quoted price, and this divergence rarely occurs in isolation. It reflects growing uncertainty about currency stability, settlement reliability, and the true availability of real assets. The hook is that while official indicators speak in averages and delays, premiums speak in urgency, responding instantly to shifts in confidence and trust. From a market structure perspective, institutional signaling reflects stress in liquidity and risk transfer mechanisms. When hedging costs rise or counterparties become less reliable, institutions reassess positions that were previously considered routine. Silver alerts or reallocations indicate that maintaining exposure has become more expensive or less predictable. This is not simply a commodity story, it is a reflection of tightening financial conditions. The hook here is that volatility does not arrive suddenly, it builds invisibly in the plumbing of the system, and silver is one of the first places where that buildup becomes measurable. As institutions respond to these pressures, market behavior begins to change. Volatility increases, correlations shift, and traditional diversification assumptions weaken. Currency markets may experience sharper moves, bond yields may react unpredictably, and risk assets may become more sensitive to macroeconomic data. The compelling reality is that institutional adjustments in silver often precede these developments, acting as an early tremor before a broader financial movement. Those who dismiss such signals as isolated commodity events often miss the larger context forming around them. The hook for economically aware observers is that institutional signaling compresses time. It shortens the window between awareness and impact. Once large players begin adjusting publicly, the underlying stress is no longer hypothetical. It is already influencing capital flows and risk pricing. In this way, silver becomes less a speculative asset and more a diagnostic tool, offering insight into the health of monetary confidence and the likelihood of increased volatility across the wider financial landscape. Before official acknowledgments and before market narratives adjust, by the time stress is visible in currencies or bonds, premiums have often been elevated for months, quietly signaling that confidence is being repriced and that the financial system is adapting under pressure rather than operating in equilibrium.